How much exposure does your portfolio have to the S&P 500? That's exactly what we're going to be looking at in this video. I want to break down a couple different scenarios to really limit or increase your exposure when it comes to specifically the Vanguard S&P 500 ETF, which is the VOO. And I'm also going to share with you my personal portfolio and how we're taking our really stance in this. Now, when you start looking at the VOO, it has surged 56% in the last 2 years, which is pretty impressive. When you look at rate hikes going up, when you look at corporate profits going up, even when you look at advancements in artificial intelligence, the index investing is something that people are on board with, dropping a lot of mutual funds, dropping a lot of other things, putting it into those ETFs, exchange traded funds, which I absolutely love. Now, one of the things that people are worried about is the adjusted price to earnings ratio of the S&P 500, sitting right now around 36, which historically is around 17. So that brings up the debate and really the question, is it overvalued and is there going to be a correction to the S&P 500? That, of course, is something we're going to have to watch and really review in time. When you start thinking of the adoption of artificial intelligence and the companies that are really driving the S&P 500 by market cap, there is a very, very big push towards the artificial intelligence, and people are utilizing it, not only larger companies, but when you start looking at bigger picture, and they are using it in every industry, almost everything we have, including looking at YouTube, looking at a lot of different things, AI is starting to be really prone and put in there. Now, of course, there's still some concerns when it comes to the market itself, looking at what the Bureau of Labor Statistics says, that of course unemployment rates are ticking up a little bit higher, and also looking at auto loan delinquencies as well as delinquencies on consumer credit cards, they are increasing. Now, this is really by design. A lot of people are worried about the increase in delinquencies, a little bit increase, to the credit card debt, but this is by design. So through the methodology of raising interest rates, making things more expensive, really limiting the exposure and limiting people's buying power is exactly what the Federal Reserve wants to do, bringing inflation down. Now, of course, when it comes to index investing, it is the only thing that I do. When you look at, some of the most successful people like Warren Buffett, he said you should hold 90% of your portfolio in the S&P 500. Now, for me, that might be a little bit higher because there is some things that are really outperforming the S&P 500. But when you start thinking of 90% of your portfolio, it is a investment vehicle through the ETF that is instant diversification. You're investing in the 500 largest companies in the United States. With that, you have instant diversification because you are into every sector that the market offers, which of course is very, very enticing if you want to set it and forget it, if you just want to put money in there. And of course, a majority of financial advisors cannot beat the S&P 500, even in the recent years, how it's been performing. Trying to pick and choose individual stocks is incredibly hard. So let's go through the Goldilocks scenarios for investors and really looking at 3 of them. And I'm going to show you exactly what I'm doing as well as that portfolio. So scenario number 1, too cold, increase your investments. If you're not investing enough into the S&P 500, looking at the transformative AI breakthroughs that we're seeing, looking at NVIDIA, looking at Meta, looking at Apple and Google, some of these major players, really, you got to have some exposure to them. And of course, you want a bigger weighted exposure to them because they are large companies. They are the ones that are already $3+ trillion and continuing to go. A lot of people are saying next 3 to 5 years, AI is going to be booming. And we're going to see it. We're going to see revolutionary breakthroughs. We're going to see a lot of other things. And again, exchange traded funds is exactly where it's at because they have a super low cost. It's actually a 0.03 cost when it comes to this. But putting more into the S&P 500 is really under the assumption that you believe in AI, you believe exactly where it's headed. You really think that it's going to deliver on the promise that it has. And knowing that, again, the AI generation is going to be coming. Scenario number 2, just right, keeping your current strategy. This is what I've been doing right now. It is the time-tested principle of dollar cost averaging. Now, if you followed my channel for a while and you're not subscribed, definitely consider subscribing to it. We have a couple of videos where we've been tracking our portfolio and of course, dollar cost averaging for the last 3 years has made an incredible difference when it comes to the growth of the portfolio. And we've been doing this on a bi-weekly basis, putting a little bit more into the market over and over and over. If it's up, we are buying. If it's down, we are buying. Now, if you remember what Warren Buffett said, if there's blood in the streets, if the market's going down, that is a perfect buying opportunity because you have the ability to buy everything at a discounted price, which I love. Now, this is a really good way and a really smart approach when it comes to the market uncertainty. Again, if it's going up, you're buying it. If it's going down, you're buying it. And of course, maintaining a pretty good degree of caution, not only because of the diversification for the companies that are in there, but also going in there and not just putting all your eggs in one basket and putting everything in here. And the third scenario we look at, too hot, decrease buying and build the cash reserves. This is another really good approach that I considered, more of a cautious approach. And this is more of the Warren Buffett quote, be fearful when others are greedy and greedy when others are fearful. This is a strategy about trying to time the market. So if you see, and this is of course decreasing what you're putting into this ETF every week, every month, and having and holding off in a larger cash position. Of course, this has its pros and cons. If you're sitting on some cash reserve and there is a correction, it gives you the ability and it also gives you the resources to go ahead and invest and put you in a very good position. However, this is trying to time the market. Now, personally, I do not under any means try to time the market because of course you might actually miss a ton of gains. And for a lot of people that were sitting with money on the sideline and that are sitting with money on the sideline without investing it and building up those cash reserves, it is really a big downside risk if you're missing all of those gains because your money is sitting liquid in cash just waiting for something to happen because you can miss out on those gains. And I know there's been a lot of studies, a lot of surveys, a lot of charting where if you missed some of the highest days of the stock market, which usually follow some lower days, you would miss out on an incredible amount of returns. So you could really underperform the market in a whole, trying to look for those short-term gains or trying to buy when the market is at a discounted. So which approach of the Goldilocks is correct for you? This really depends on a couple things, including your risk tolerance, the investment goal, your investment horizon, and how you think the development of current market conditions with interest rates and artificial intelligence is going to do. Now, overall risk tolerance, in my opinion, this is kind of mitigated by the dollar cost averaging that I do. Investment goals for me personally, we are trying to get this portfolio to $1 million as fast as possible, and we are making regular contributions to really make that happen, which of course, the investing horizon, I have 20 years till 65, retirement age, or now looking at 67. So that would give me 22 years with an investment horizon. That is a long, long runway to be stocking up the portfolio. And of course, do I think AI is going to be there? I am seeing it. I am seeing it incorporated in so many things. Even when I look on a professional side, looking at a lot of the financial space, looking at a lot of the banking space, there is a lot of artificial intelligence, a lot of AI that is being built in a lot of things. But then I also look on the flip side, on the YouTube side, artificial intelligence is being built into everything, including Google platforms, including YouTube. There is so much that is going in here. Even when you look at Microsoft Edge, things of that nature with Copilot, AI is here and AI is being built into everything. So should you invest in the S&P 500? Absolutely. The S&P 500 is really a driving force. And when you look at instant diversification, if you literally just put money in the S&P 500 over the last 20 years, you would see about a 14% return, which is pretty crazy to think that you can see that kind of return. So let's hop over. I want to break down the portfolio and show you exactly how I'm doing this. So let's take a look. All right, guys. So if you remember the portfolio, this is exactly how it looks as we are today. I remember a couple months ago, we hit our 100,000 mark. As you can see, we're at 118 right now. And I just want to show you, looking at the graph, it's funny to see the graph that literally just almost goes up. Had the small dip, which was a couple days ago, the value dropped quite a bit, but overall the market does recover like it always has. But breaking it down, so September 26th of 21. So we are coming up on our 3-year anniversary for this account. As you can see, we've made around $2,000 in dividends, but looking at a $24,000 market gain, which is incredible. So looking at our cash flow, we have seen almost a 25% market gain, which is, again, pretty incredible to think over the last 3 years. Money weighted return is 76%. Thinking of the last 3 years, we have returned 76% in this portfolio. This is through dollar cost averaging. Now, of course, investing every 2 weeks on a regular basis over the last 3 years has made a tremendous difference. We haven't done any leveraging, we haven't borrowed on any margin, we haven't done anything of that nature. We did change up the investment portfolio. We actually had 4 in here. We did have at what point some of the new Bitcoin ETF. We dropped out of that. We've been sticking with a very, very solid portfolio. And I feel like this is going to be the one that we carry for an incredible amount of time when it gets into retirement. Now, this is based on and really built on 3 ETFs, as we can see right here. You can also see the weighted average. So the QQQM is something we've talked about, the Invesco NASDAQ 100. So this includes the 100 largest technical companies within the United States, but it takes out the financial institutions. So that is the big thing. There are no financial companies when it comes to the NASDAQ. That is where we are seeing, again, a little bit of growth. And this is one that I invested in actually quite a bit later. As you can see over here, we're sitting at a 25% increase. Now this one, again, I have not held this for the first, I think this is about 6 or 8 months old, that we've seen a pretty good growth in here. Now the portfolio originally was the VOO, the Vanguard S&P 500, that we have held, and we have held in the entirety. So again, thinking of those last 3 years, we have made a 70% return on the S&P 500 on the Vanguard. And of course, that is the highest portfolio or the highest percentage for the gain. But that is because we were invested in a couple different things. And again, that VOO, we were only invested in the VOO for a considerable amount of time. Now, also looking at the SCHD, this is the dividend growth. This is the return. Now, the way that I play this, and the way, if you can notice, I have 40% into this QQQM. Now, the reason for this one and really focusing on that big 40% is when you start looking at this return, it is really high when it comes to technology. I want to have the exposure to AI, which is what we're doing with the combination of QQQM and the VOO. But having that heavy exposure to AI, this is going to be the growth ETF. This is the one that I'm going to hold and slowly put different percentages in as we continue to go ahead and build this portfolio. So every so many years, I'm going to adjust the percentages. Then through contributions, I am going to let the portfolio auto balance. For instance, with the QQQM, this is one I want to hold for probably about the next 10 years, see exactly how it performs. Then I want to move some of that into the VOO. So even moving, let's say 3 to 5% in the VOO, and then also putting a little bit more into the SCHD. As we get closer to retirement, so let's say at the age of 60, we can even have, 25%, maybe 30% in the QQQM. So again, pulling back our percentages in one ETF to buy up and stock up on another ETF. And again, purchasing more of the VOO and the SCHD. Getting to the point of retirement, I want to have probably about 50% in this SCHD, 50% in the VOO. That is still going to allow me exposure to, of course, all of the large companies, a lot of the tech growth that we see, but it is also going to provide me 50% in the SCHD, which of course is going to be the dividends. This is going to be the moneymaker. This is going to be the one at a point we are going to start taking dividends out of this portfolio. I'm going to let the VOO grow, as you can see right here. And I anticipate within the next 10 to 20 years, since we've grown this 100,000, and of course, now we start seeing the snowballing effect. But if I can put 100,000 in here every 3 years, so in the course of like the next 10 years, we can probably get close to 400, maybe 500,000, depending on the growth. And then of course, getting to retirement, getting to the point where supplementing income that is coming from the SCHD versus having a traditional 9 to 5 job, looking at early retirement and where that money is going to come to bridge the gap if we're going early retirement into the point of full retirement. Social Security income is going to make a big difference with the portfolio. Now, guys, this is one portfolio that I have of 3. We're slowly building it out kind of little by little, and I'm super happy with the performance. And again, up market, we're buying, down market, we're buying. It doesn't make a difference which way we're going. We are always buying, always putting it into this portfolio, and it will auto balance and auto rebalance as we continue to build this out. Even when you look at shorter time frames, so even when we look at like the last month, a lot of volatility here, up 2%. When you look at 3 months though, you're talking 5.8. Even looking year to date, so going back to January 1st, it's up 16%, which again is kind of crazy. But looking at the QQQM, it is growing at a faster pace than we're seeing with the VOO. That is because of the heavy tech investment that we have and the stability of the SCHD. Even though we're getting returns, even though we're seeing our dividends come out of that ETF, it is still growing at 11%, so still doing incredibly well. And then, of course, when you start going back 1 year to the 12 months, you can see that we're at 27.5%. But even here, guys, 29, the VOO outperforming the QQQM. And of course, the SCHD still at 16%. So super happy with the portfolio. We're going to definitely grow this. But that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching. When it comes to picking stocks, it can be incredibly difficult, which is the reason why I do choose ETFs. And in today's video, we're going to be looking at Ken Griffin's massive, massive buys. Now, of course, if you're familiar with this investor, he is worth $38 billion. Founded Citadel in 1990, which has become the most successful hedge fund of all time. Now, in Q2 of 2024, there were two major ETF purchases that were really bought in hand over fist when it comes to building these. Now, Griffin's big buys on the ETFs, the first one was the Spider S&P 500 ETF Trust, which is the ticker symbol SPY. This is one we've talked about before. Now, when it comes to index funds, when it comes to this S&P 500 ETFs, it is one that I personally hold in my portfolio. Now, we like this ETF so much, they added 2 million additional shares, which takes the hedge fund, and again, the most successful, largest hedge fund in the world, to a stake of roughly 57% in that S&P 500 fund. Now, of course, that is a massive purchase. And as we know from this fund, it tracks the S&P 500, which is the 500 largest companies within the United States based on the assets under management, or the AUM. This fund specifically is the most heavily traded ETF in the world. Now, the other one that we're focusing on in this video is looking at the Invesco QQQ ETF, which again is another one that I hold and I have held for a lot of time. They've actually bought 2.82 million shares of the ETF, and they increased their position into the Invesco QQQ by nearly 600%. So when you think of the combination of these two, and that's what I want to look at, is the holdings they have and really what they see, thinking of one of the most successful hedge funds in the world and seeing exactly how they break it down. Now, when it comes to the QQQ, we've seen commercials, we've seen a lot of things on Facebook, we've seen some on YouTube, but this tracks the NASDAQ 100. This is where it is different. The S&P 500 tracks that S&P 500 index. The Invesco QQQ tracks the NASDAQ 100, which is the 100 largest non-financial companies on the NASDAQ stock exchange. So a little bit different because they are not including those financial companies in there. Now, of course, this was launched in 1999. The ETF ranks number 5 based on the value, and it is the one of the 10 heavily traded ETFs that we see in the market today. So why? What was the logic? What was the reason to make the shift and do these really massive purchases when it comes to loading up on these? Now, of course, when it comes to Griffin personally, doesn't really comment, doesn't really say anything that he's doing individually. But when you think of the aggressive buy, not only in the large caps, but in that NASDAQ 100, it is really proven in showing that there could be a really big focus coming, which we know is going to be the case, focusing on artificial intelligence. When you start looking at 9 of the 10 holdings in the Invesco QQQ and AI stocks, that's what they have. So looking again at the top 10 in that Invesco QQQ, 9 of those are heavily focused in that artificial intelligence space. Then you move over to the S&P 500, 10 of the holdings, 8 of the 10 of the holdings are invested in AI stocks. So when you think of the overlap, there is going to be a lot of overlap between these two. But when you start thinking about the 3 stock portfolio, 3 ETF portfolio that we kind of talked about before. Now, this, of course, focuses on the growth factor. For me personally, the big growth factor in here is going to be the QQQ ETF, which is going to be very heavy into technology. This is going to be the one that is going to grow. This is going to be your absolute rock star. When you start looking at the last 5 to 10 years, these ETFs have been performing exceptionally well, and they continue to perform exceptionally well in the marketplace. So these, again, both of these, and I am happy to see that both of these I do hold. And then, of course, when you start looking at bigger picture, the artificial intelligence space, and trying to get that fundamental ETF, this is where the S&P 500 index comes in. Now, of course, I do not own the SPDR, the Spider S&P 500. I own the VOO, which does have a lower expense ratio. That is the reason. And then in comparison to that QQQ, I do own the QQQM. So again, lower expense ratio on both sides. So should you buy these ETFs? That is the question that everybody wants to know. Now, of course, do not make your assumptions on a YouTube video based on what I say, based on what billionaires say. Do not make your investing decisions solely on what other investors are doing. This might be, and honestly, when it comes to doing something like the S&P 500 index funds, it is very, very important that you do your research before you get into it. But when we look at, billionaires like this, when you look at Warren Buffett, when you look big market picture, employing and really going into the S&P 500 is something that a lot of people are saying that is where you should put your money. Really an investment you can put money into on a regular basis. It is going to grow in time and really set it and forget it. Now, of course, when you look at these two ETFs, you could really say that they're super bullish, not only on the US economy, which we know has been booming. When you start looking at the US based economy, we are about 50% of the global economy in its entirety. Now you couple that with the growth we're seeing with AI stocks. And if you want diversification, both of these are going to provide it. Again, one part is going to be the big growth part, which is that QQQ. One of it is going to be your foundational ETF, which of course is going to be that Vanguard 500 or the S&P 500 from Spider. Those are going to be the foundational. And then the third one that I focus on in that 3 ETF portfolio is really heavily focused on the income. So the generation of income through like a VYM, which is the Vanguard high yield fund, or looking at the HD. Those are other ones that I do carry in my portfolio. Now, the reason being, when we see the generation from the HD, it is reinvested into the portfolio, which again does carry the QQQM, and it also does carry the VOO as well as that HD. So as we're getting those dividend distributions every quarter from those ETFs, it is going right back and compounding into what we own in both the growth and that fundamental ETFs, those foundational ETFs that we do provide. And literally it is just going through here. Now, the other one I did want to touch on is the Vanguard Mega Growth ETF. That is what a lot of people do instead of investing in that Invesco QQQ. But of course, the Vanguard one is a little bit cheaper when you start looking at that Mega Growth ETF. But overall, when you look at the expense ratios, that is kind of a little bit different. And of course, the Invesco QQQ has outperformed the Mega Growth Fund over the last 12 months. So you could see a lot more growth out of the QQQ than we see out of that Vanguard Mega Growth ETF, which again is the reason why I personally do own that Invesco QQQ and as well as that Vanguard S&P 500. Because when you start looking at the annual expense ratio, the Vanguard S&P 500 is only 0.03, where the Spider one, even though it's a 0.09, it is 3 times more expensive to hold the identical funds because, of course, both of those funds, the Vanguard and also the Spider, are tracking the S&P 500 index, which has little to no difference because they're always going in and they're tracking the exact same index. And then again, the QQQM, which focuses on the NASDAQ 100. So taking out all of the financial aspect of those stocks and really putting more of that growth aspect into the technology, into the artificial intelligence that we see. So again, these two ETFs are two that I personally hold. These are two ETFs that I would highly advise a majority of investors if you're looking to save money, if you're thinking retirement, long-term growth, anything of that nature. Both of these ETFs are going to do incredibly well and have performed incredibly well. Now, of course, when you think of past performance, doesn't really show you what they're going to do in the future. But overall, in the decades that I've been investing, putting money into these and putting it in there on a regular basis has been an absolute game changer when it comes to the growth. So, all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching. If you ever take a look through your bank statement, it seems like money is just vanishing, that there's a leak in the wallet or something just isn't right when the math adds up. Now, for you and I, a lot of people feel chronically broke because of money pits that we fall victim to in our regular expenses. Now, of course, everyday habits can really add up in a big way. That is what we're going to focus on this video, ways to cut out some of the chronic expenses and really thinking about these systematically, how you can save money, giving you more money for debt repayment or saving, investing, building up that emergency fund. So let's go ahead and get into this. Starting with our first one is food waste. Now, it's kind of crazy when you think of the food you have in your pantry, when you have it in your fridge, it's like throwing away money. The cost of food has just astronomically gone up. And if you've been to the grocery store, really $100 doesn't buy you much. However, it still shows through the USDA that it's estimated that 30 to 40% of the food supply is waste. It goes uneaten, it goes into the garbage. Now think about this for a minute. If you look at your food bill and let's say 30% of that food bill you have, whether it's $200, $300 every single month, is going into the garbage can, you are throwing a ton of money away. This is where meal prep comes in. Now, of course, meal prepping does take a little bit more time, but if you're going to the grocery store and you know exactly what you're buying, and of those items you're buying, those are items you are going to be using for the meals that you already know that you're going to be prepping through the week. Even if you don't go in and physically prepare the food, you have all the ingredients needed to prepare the food, making it much easier. And of course, not having to take a multitude of trips back to the grocery store because the impulse spending can be super expensive. When we look at number 2, it is cable packages. When you look at the cable bill, when you think of Xfinity, when you think of Wow, when you think of all of the other providers out there, it is an average monthly cost of $217 for approximately 500 channels, which again is kind of crazy when you think of the way that you watch TV and really the methodology behind it. There's no way you're watching 500 channels. You might have 3 to 5 that you could get different places. Now, years ago, we did go ahead and we cut the cord, saving $189 a month. We picked up a couple streaming services. So overall, netting about a $140 gain from us personally cutting the cord. And of course, we are still watching those channels that we watched with cable. We are just watching them now with a digital TV or streaming TV, which makes a really, really big difference. When we get into number 3, it is expired makeup and skincare products. Now remember that creams, foundation, things of that nature, they don't last forever. They do have an expiration date. Even though if you're seeing that expiration date and it's past that expiration date, it can be very harmful for your skin. Tossing them out, of course, is going to feel like a waste of money. This is the reason to declutter your cosmetics on a regular basis, making sure that not only do you have them that are not expired, but you're only buying them when they are needed. A lot of people will stock up when there's a sale or you want to get a good discount on it. And ultimately, those products do go unused. Number 4, we get into single-use items. When you think of paper towel, plastic wrap, paper plates, disposable coffee cups, all of those things you're buying and throwing away as a one-use item. And even with those, when you think about that, it is very, very wasteful for the environment. Not only is it a constant drain in your wallet because those items always have to be replenished. This is where a lot of the reusable alternatives could be used, especially looking at things when you look at coffee cups, the reusable coffee cups, investing in things like food wraps, travel mugs will pay for themselves very, very quickly when you look in comparison to the single item and the single use items that you do have. Number 5 is one of my personal favorites, which is unused gift cards. It is kind of crazy when you think of gift cards and when you think of unused gift cards, whether it's tucked away in drawers or it's in a wallet or in an email box somewhere, those gift cards are completely lost money. And for a lot of people, which is kind of crazy, most people do not use gift cards like we think. And especially when it is store specific, it is not used as much as one would think. Now, it is estimated that $3 billion in gift cards go unredeemed every single year. That is a lot of purchasing power that we're leaving on the table. Now, of course, round up, keep track, really manage your gift cards before they potentially expire, or even a lot of gift cards, once they hit that 12-month period, they will actually start depreciating to the point of getting them to a zero balance. We've seen even some of the gift cards that have depreciated by $5 every single month after the first 12 months. So essentially, your gift card balance is all going to go back to the company that you essentially gave the gift card through, and now it has no value. Looking at number 6, neglecting warranties and insurance. Now, this is a part where I feel like a lot of people don't really understand extended warranties on appliances, homeowners insurance, renters insurance. You never know what is going to come down in really the unexpected version. We really don't look at the fine print for a majority of us. If I ask people, what does your warranty cover? What is your insurance policy? Most of those people are not going to know and have not and do not have an answer. But then when it comes to costly repairs to a home or an auto loan, what exactly is covered in those policies? What is covered with those really nuts and bolts? Number 7, it gets into the FOMO, the fear of missing out, driven entertainment. Entertainment is super expensive when you start looking at apps, when you start looking at streaming services. Not only the cost of them themselves, So when you think of having Netflix, having Apple, having, so many different streaming services can really put a big, not only strain on your budget, but it also puts a really big strain on your time. That time could be used in a lot of more productive ways. I know a lot of people like to watch TV, they like to relax, but overall, the time that is invested in it, you could do something different. And also with the big FOMO part, when you think of a lot of people that want to participate in social events, checking out new restaurants, seeing all the new hype for the movies that are coming out, especially Wolverine and Deadpool, naturally, it is a natural instinct. You don't want to miss out, but this can really lead to overspending when it comes to trying to budget and trying to make sure that you do live within your means. Number 8, we get into overpaying for phone and internet plans. This is another one. When I see phone plans, when I do the financial counseling, when I see phone plans that are $200, $300, $400 a month for a phone plan, I really wonder what are they getting and what are they really benefit for. If you've been with the same subscriber for a number of years, possibility you could get it cheaper elsewhere. If you're with Verizon, T-Mobile, AT&T, any of those, shop around. Don't be afraid to renegotiate your bill. See if you can get the same services for lower. And of course, most of these companies are very, very big on not only acquiring new customers, but also the retention of what you have. I actually did this recently with my iPhone. If you guys remember, I had an iPhone 7, was looking for an upgrade. Finally, after bickering and really talking to Verizon on multiple occasions, they called me out of the blue and said, we'll give you an iPhone 15. It's going to run you $100, which you'll pay over 3 years, which is kind of crazy because I'm happy to do it. But I got the new phone for $100 versus paying the $1,600 price tag that they wanted me to pay. Number 9 is another big and pet peeve of mine, late fees and interest charges. When you look at credit card payments, when you look at auto loan payments, library books, everything with a very small fee is what is eating into your budget, what is eating into your ability to really pay this off. When you start thinking of interest, and this is another thing that I've always said is a big challenge to you, see how much interest you're paying in a monthly period. Now, of course, divide that by how much you make an hour. You can even round up or round down, regardless of what you want to do, but you'll have an actual number on how much you're paying on an interest basis on a monthly basis. And of course, you could be saving that money by putting more money, paying down some of those. And late fees are, again, a really big pet peeve of mine. There's no reason that you should be paying monthly fees for checking accounts, late fees, overdraft fees, anything of that. Guys, it's 2024. There's no reason to be doing that at all. Number 10, buying new when used will do. This, of course, is a huge part. Facebook Marketplace, thrift stores, online places, consignment shops, even looking at used vehicles. Honestly, there's not a really big driving force to buy brand new. When you look at secondhand things, a lot of times you can cut the cost of them 30%, 50%, 70%, or even more depending where you are, and really change your shopping mindset. It doesn't have to be brand new. And if you are buying brand new, make sure it has value. That's one of the biggest things. When I start looking at some of the nicer retailers, the quality of the product for a lot of parts are there, some of them not so much. So make sure you know exactly what you're buying and what is the price tag that you're running behind there, and also what is it going to cost you in your budget. Now, number 11, healthy snacks and drinks. Trending wellness drinks, fancy protein bars, packaging healthy snacks do come at a very, very big premium price. If you look at Whole Foods, if you look at homemade snacks, they are often a lot more cost efficient and they are a lot more healthier than we see with some of the alternatives. The thing is the marketing. When you start looking at the commercials, when you see the infomercials, when you see the Facebook ads, a lot of things really give you the illusion of health, even though they might not provide the benefits that you're thinking they do. And of course, it comes with a really big price tag because they know exactly how to sell that with the marketing that they have. Number 12, we get into extended warranties on your low risk items. These are very tempting to purchase. And if you've been to Target, if you've been to Walmart, everything comes with a replacement plan. Even interesting enough with buying video games. So we bought some Switch games. Switch games have like a $4.99 repayment plan. So if something happens to it, they will actually give you another one for $5, which again, the insurance on here, I don't know how often video game cartridges or anything are going bad, but everything where I bought a cord for my phone and it said they wanted a $399 protection plan if I wanted to add it to my cord for the next 12 months. It's kind of crazy, but companies are making a ton of money. Retailers are making a ton of money when it comes to the profitability of selling these warranties, because most people are not going to track it. Most people are not going to replace anything, which means they are just taking your money, and that is exactly what they get. Number 13, expensive haircuts and salon services. I know it's always good. It's a luxurious experience to go in, treat yourself, very straightforward. But when you start looking at haircuts, color treatments, manicures, you can be spending hundreds of dollars. And again, this is something I do through the financial counseling process, that I see people that are spending hundreds of dollars in just maintenance that cannot afford it. Research your options. There's a lot of better ways. There's a lot of beauty schools. There's a lot of things that you can get at a significant reduction, even if you do it, by yourself or you're doing it a la carte. There's a lot of services that you need, not only that you can acquire home beauty skills, but a couple of different ways that you can. YouTube, great source if you want to do it yourself. And again, doesn't come with that massive price tag. And the last one that we look at is not weatherizing your home. When you start looking at money literally leaking out of your house, drafty windows, leaky faucets, inadequate insulation, really just costs you money. They drive up the energy bills, forcing you to essentially cost more for the heating and cooling system. If you've looked, they are about $7,000 to $15,000 to replace an HVAC system. Doing a little bit of winterization, even DIY, going through, like a Lowe's or a Home Depot, incredibly budget-friendly, do-it-yourself, caulk around the drafts in the windows, installing weather stripping, a lot of different ways that you can actually save a considerable amount of money when it comes to really breaking it down with exactly what it is. So, all right, guys, so that is going to break it down with 14 money tips that can make you and do make you chronically broke. So let me know in the comments what you guys think. And as always, thank you guys for watching. Saving money is much easier said than done. According to a 2024 survey of 1,000 Americans, 28% have a savings below $1,000. Now, this does include savings accounts, emergency fund, workplace retirement accounts, investments. That means over 1/4 of Americans have nothing, have zero. It is so paycheck to paycheck. They don't even have the ability to invest or save any, even in that 401k plan. So in today's video, we're going to be looking at 6 ways to save money according to some financial gurus. Let's go ahead and get into this. Number 1, starting with automating your savings. Now, this is the biggest thing. Most individuals never learn to save properly. They don't start at a young age, and they are not taught by their parents. It is really the behavior that is habitual to pay yourself first, to have the ability to pay yourself. And of course, it is not easy. The best way to do this is to automate your savings. I have said this for an incredible amount of time, is if you're looking to save $50 a month, $100 a month, $10 a paycheck, whatever it is, the automation of this will make sure you don't miss it, and it's not throwing out your financial goals and really throwing them off through that automation process. Now, this, of course, is very easy to do. You can set it up, you can forget it. Payroll distributions are really the easiest one, as well as 401k contributions. When you think about getting in there and earning free money, getting free money, the employer contribution plan, if they're matching 4%, 5%, 50 cents on the dollar, whatever it is, you do not want to leave free money on the table, and you want to automate the investments and automate the savings that you have. Now, the second one we look at is earning more money. On the flip side of saving money, earning more money, it can really stop you from living paycheck to paycheck. Majority of individuals, even high earners over $100,000, are just living paycheck to paycheck. Some easy ways like this, you could ask for a raise, even if it's $1, 50 cents, $2, whatever it may be. That is an instant way to earn more money. When you think big picture over, a couple paychecks, couple months, even a year or two, this could make a big difference. Now, on the flip side of this, you can earn more money with earning income outside of your job. Now, this, of course, can be dividends if you are saving money. It could be a lot of different things, including a side hustle, becoming a freelancer, becoming a YouTuber like we have right here, getting a second job, making your own business. But of course, YouTube is what I chose to do for the side hustle to earn more money. So if you like the content that I'm putting out, please subscribe to the channel, and let's get into number 3. This is on the other side of avoiding bad debt. Now, when it comes to bad debt, what you do with your savings is very important. It's not about how much money you make. It is about how much money you keep from that paycheck, how much you have for debt repayment that you can stash away, that you can invest. It will allow yourself the freedom that we look for in the debt-free journey. And of course, it makes a big difference when you look at bad debt, specifically looking at credit card debt. Credit card debt is an absolute pandemic when it comes to the United States. We have almost $1.2 trillion in credit card debt. And of course, right now, we're also sitting on high interest rates. I was actually just working with an individual, had a pretty high balance on the credit card. We pulled the APR, and guess what? 36.99%. That is right. There is a card, and it was actually from a retail store that was at 36%, almost 37%, which I believe that is the absolute cap that you can have. Now, of course, every extra dollar that you're putting in there trying to avoid this bad debt is going to give you that 37% return. So it's kind of crazy. Now, you can save on credit card interest. You can prevent overspending. You can do balance transfers. There's a lot of different things you can do, but a lot of people just use cash. When you think of using cash, there's no overdraft fees, there's no charges, the bank's not earning interest, you're not paying interest on the purchases you make. If you have a trouble and you're really struggling with credit cards and you're struggling with that credit card debt, consider using cash, even if it is for a short term. You could even look at doing prepaid cards, which again makes a really big difference because you don't want to be accumulating the interest. And even if you do the consolidation, if you do some of the balance transfers, you want to make sure that you're not continuing to use the bad debt and continuing to run up those credit card balances. Now, number 4 that we look at, living below your means. This is something that I know, don't spend what you don't have. You have to have a life and live below your means, but within your needs. That is very important to note. That, of course, is Susie Orman, which says, living below your means to a certain point where it has to be within your needs. So when you think of fundamentally, you have needs, you have wants. If your needs are not being met by your current income, there is no way you're going to make it. Now, when we think of needs, these are the basic fundamentals. These are housing, these are food, these are safety, this is shelter. That is within the needs. But this can be a little bit construed when it comes to what exactly the needs and the wants are, because of course there may be a need for transportation. You have to get to your job, you have to earn an income. However, does it look like you're driving a $10,000 used car that is taking you from point A to point B reliably, but are you buying a $70,000 car to do the exact same thing? So again, the justification has to be in there. And of course, saving, you have to start saving. You have to start investing. It is a conversation that I have almost on a daily basis with a lot of individuals. When we get into number 5, don't spend money to save money. This is one of the common misconstrued and misconceptions that I do see. Spaving, which is a relatively new term, means spending more money to save money. Think about that for a minute. Retailers, marketers, all of them know exactly how to get you to spend those extra dollars, and putting more money in the cart, adding one more item in the cart to get free shipping, putting another item in the cart because it's on sale, putting an item in a cart to get saved 20%. This is really a big way. It is a marketing gimmick. It is something they are playing on your psychology to get you to buy more things that you don't need. Now, of course, this is the important behind deals and sales. There is a difference between those two. When you think of a deal, companies know what they're doing and they know what you're going to fall for. It is a very historic and a very classic marketing. And of course, the justification. A lot of people do have the justification where, hey, even though I'm spending more money, I'm getting reward points. That is wrong. When you look at the interest that you're paying, when you look at the overall bill you're going to be paying, buying more things you're not going to use are not saving money. We can always see this even going back as far as buy one, get one, or the BOGOs in stores. And of course, some stores will just mark down the price to 50% when you purchase one item. So again, there are a couple hacks that you can do in here with the BOGO deals. Sometimes you either get buy one, get one free, or it's buy one and really you can't buy one at 50%. You have to pick up the second one and pay essentially the same price. And the final one we look at, which of course is the absolute biggest one when it comes to savings, is to start investing. The earlier you start investing, the more, of course, you're going to take advantage of that compounding interest. If you invest $4.25 a month or $14 a day, starting at age 25 to 65, you will have over $1 million and well over $1 million. And it's that basic. It is that simple. Now, of course, it is the assumption of starting investing at 25, putting away a pretty decent amount, $14 a day, and then of course looking at a roughly a 7% return. Right now, the stock market, the S&P 500 has been doing a lot better than that. And overall, even if you start off with a basic, very, very fundamental of putting in, 1%, 2%, 3%, your goal here is getting to 15%. So how do we do this? When you start a job at 18, you put in your 1%, or at least the minimum to get the company match. Increase it by 1% every year with your annual raise. So if you get a 2%, 3%, 5% raise, 1%, you're still going to be seeing some of that raise. You're still going to be seeing some of that into your paycheck. And then, of course, eventually within the next couple of years, you can get to the 15%. Once you get to that 15%, you are going to keep this for the rest of your life until you're ready to retire, till you're ready to really cash out. Because at that 15%, when you get raises, when you get promotions, when you go to a different job, you start your career, that 15% can save you and really build up to hundreds of thousands of dollars in an investment portfolio. When you put and look at it over a multitude of years, it can make a big difference between having a healthy, well-funded retirement or struggling with Social Security to get by. All right, guys, so that is going to do it for today's video. 6 ways to really save according to some financial gurus that we see. Let me know in the comments what you guys think, and I'll catch you in the next video. Hey guys, welcome back to the channel. Today's video, we're going to be diving into a topic that completely changed your financial future and your financial life, which is daily habits. Imagine transforming your financial life, gaining control of your money, and working towards financial freedom through the simple and daily steps that we have. Sounds very amazing, right? So let's go ahead and get started transforming your financial life with these habits. First up, it's crucial to set financial goals that are very clear and concise. Might sound very basic, but you'd be surprised. Almost everybody that I sit with absolutely skips this step. It is probably the most overlooked thing that I see within the financial education space. Now, this is also to include setting short-term and long-term goals, gives you a very clear direction of where your finances are. This is also going to include your emergency fund, paying off your debt, saving for retirement. Knowing your goals helps you not only focus on the daily efforts, but you know exactly why you're doing what you're doing. Every day, reminding yourself of these goals is going to make a difference, and it also does keep them in the forefront of your mind. Second point of this is creating and following a daily budget. Now, with budgets, it isn't just a monthly task. It is something that you need to guide your savings and your spending decisions on a daily basis. This could include applications, spreadsheets, notebooks, any way that you track your expenses, as long as it works for you and you're tracking them. This could also include making a savings plan or making a spending plan and adjusting as needed. You always want to try to stay under your budget. Daily practice helps you be very aware of the money coming in, the money going out, and exactly where you're doing and what you're doing with this. Because of course, it's not about how much money you make, it's about how much money you can keep from your paycheck. Third, tracking expenses. Yes, I know when you start tracking expenses, it can seem very tedious, whether it is the morning coffee, the grocery run, writing down, entering everything to an app, or even having an app that consolidates and really puts all those expenses together. Tracking expenses will keep you conscious of your spending habits and also noticing patterns. When we start thinking of subscription services that are just on a monthly basis, when you think of impulse spending, there are a lot of things that you can really notice when you start tracking that budget on a daily basis. These little expenses can really be detrimental to a budget and can really add up over time. Next one we look at is automating your savings and your investments. For me personally, this was the biggest game changer. Setting up automatic transfers from checking accounts to savings accounts, from checking accounts to investment accounts. Or for me personally, I have a portion of payroll deductions that go right into M1 Finance. M1 puts it right into my investment account, and it happens automatically. That's right. Consistently, I don't have to think about it. A portion of my income is set it and forget it, going into that investment account, which of course makes the approach for investing absolutely effortless and really creating that wealth. And of course, guys, if you like the content that I'm putting out there, definitely consider subscribing to the channel. And let's get into number 5, prioritizing the debt repayment. This, of course, is huge. When you really start making it a habit to pay off anything that you can daily, weekly, monthly, making sure even if you have a couple extra dollars that you're putting it towards debt, using a strategy like the snowball method, which of course, paying off your smallest debt first to your largest debt, or the avalanche method, which is based on the highest interest rate. Reducing your debt means you have less money wasted on interest, and you have more financial freedom. Again, it is about how much of that paycheck that you are keeping when you start thinking big picture. Number 6, practice mindful spending. This is another one. Practicing mindful spending for me has been an absolute change. Before you make a purchase, ask yourself, do I really need this? Is it worth the money that I'm spending on this? Can I find a cheaper alternative that fits the same bill? And of course, does it add value? That is one of the biggest things that I feel a lot of people will lack is they will buy out or they'll have a cheaper alternative that doesn't quite have the quality or have the value that is provided from an item from a far superior item. Being very mindful of your spending helps you avoid the impulse buys, which we know are racking up about $2,000 to $3,000 a year when it comes to the budget, keeping you focused on those daily financial goals. Now, of course, this habit not only saves you money, but it also gives you a much better relationship when it comes to spending. And you know, when you're spending your hard-earned money, that you are getting value from what you are really purchasing. Number 7, we look at reviewing your financial progression. This can be on a daily basis as well. Make it a habit to spend 3 to 5 minutes reviewing your progression. This could be simply logging into your bank account, checking out your balances, reviewing your budget, looking at your net worth, really monitoring and adjusting. Spending a few minutes every day will keep you informed about all your financial situations. And it does also help you stay on track, providing you a sense of accomplishment as you see the progression within there. Now, of course, for a majority of us, and definitely let me know down in the comments below, I check my bank account every morning and I make it a habit to just check it once. A lot of people, you can really get tied up in checking it 3, 5, 7, 10 times a day. Even if nothing changes, even if there's no adjustment, it can be an absolute hole that you kind of fall into with the time progression and the amount of time that you spend reviewing that financial progression, even though nothing changed. Point number 8, we get into educating yourself. Now, dedicating time to educating yourself about personal finance, reading articles, listening to podcasts, watching YouTube videos like what we have right here, really looking at topics like investing, budgeting, financial planning, all which we have available on this channel. The more you know, the better decisions you can make. Financial literacy is an ultimate powerful tool. Learning a little bit every day, even if you're doing 5, 7, 10 minutes every single day, it will impact your financial future. And of course, the more that you're educated, the more mindful decisions you can make, which can add a lot more value to your life. Number 9, and this is one, again, I know a lot of people do kind of struggle with, using cash over credit. Using cash or debit cards to actually pay for things instead of using a credit card is a very simple habit. Now, a lot of people think that credit or using debit is the exact same. Credit cards versus debit cards. Credit cards, we have known there has been a lot of surveys, a lot of studies that people that use credit cards and only credit cards spend about 20% more than people that use cash and debit cards. This is through the justification of reward points. Simple habit helps you avoid unnecessary debt, and you can only spend what's in your account or what cash you have, which is huge. You actually have to do it. This keeps people from overspending and falling into credit card debt, which we don't want to see. Number 10, reflect and adjust on these daily habits. Finally, taking a moment each day, again, doesn't have to be super time consuming. You're talking 3 to 5 minutes. Reflect on what you did for the day, adjust as necessary. At the end of the day, review your savings, review your spending habits, see exactly where you are, celebrating the small wins. Can you stay under budget? Can you make wise investments? Where's the money going? If you've made a mistake, it's okay. Another day will come. You have time to make some adjustments with the next day. Consider reflecting and adjusting. Constant reflecting and adjusting will help you stay on track and improve your financial health over an extended amount of time. And there you have it, guys, a list of 10 habits that will transform your financial life on a daily basis. Remember, it is small, consistent actions that will make a difference. And of course, those differences will snowball. When you start incorporating these habits into your daily life and your routine, you will have more control over your finances and you'll move closer to that financial freedom and being absolutely debt-free. Now, if you find this video helpful, don't forget to like and subscribe, share it with others, and I'll catch you in the next video.